Welcome to Finance for World. Today, we're diving into the absolute high-wire balancing act that is the mid-2026 global economy. It's a wildly complex landscape out there right now, right? On one hand, corporate resilience is just booming. But on the other, we've got this stubborn, sticky inflation and some intense geopolitical uncertainty. We're going to unpack exactly what the data is telling us today, leaning on some deep insights from Morgan Stanley, FactSet, LSEG, and more. To help us efficiently navigate all this, we've broken today's explainer down into 5 main areas. First, the U.S. equities boom. Second, Fed rates and inflation. Third, geopolitics and commodities. Fourth, Asian and emerging markets. And finally, the rise of CBDCs. Okay, let's kick things off with Section 1, the U.S. equities boom and corporate resilience. So looking at the incredible strength of the U.S. stock market right now, Morgan Stanley actually predicts U.S. equities are going to continue leading global market gains. They're forecasting a solid 12% advance for the S&P 500 over the next 12 months. But look under the hood, the real showstopper here is this staggering 27.7% blended earnings growth rate in the first quarter, according to FactSet. And blended just means we're combining actual reported earnings with estimates for the companies that haven't reported yet. If this holds, it's literally the highest earnings growth rate we've seen from the index since Q4 of 2021. That's the 6th consecutive quarter of double-digit earnings growth. 10 of the 11 sectors are up year over year, really heavily driven by infotech and comm services. Corporate America is absolutely flexing its muscles right now.
But here's the kicker, it's not just earnings. Revenue growth is visibly breaking out right alongside them, hitting multi-year highs. This is crucial because it means companies aren't just aggressively cutting costs to artificially boost the bottom line, they're genuinely bringing more cash through the front door. This 11.4% blended revenue growth rate, that is the highest we've seen since the second quarter of 2022. The utilities sector, plus some absolute monster beats from mega-cap tech and financial firms, have been the heavy lifters behind this impressive upward trend. And this next stat really shows the breadth of that corporate resilience. 84% of S&P 500 companies are beating their earnings per share estimates. This isn't just a handful of tech giants dragging the rest of the market across the finish line. It's a massive, widespread phenomenon. To put that into perspective, the 5-year historical average for beats is 78%, and the 10-year average is just 76%. So hitting 84% tells us that despite all the macro noise, these businesses are navigating the current environment exceptionally well.
Which brings us to Section 2. Fed rates and inflation, where we're seeing some serious macro headwinds. Now, while the corporate side is thriving, central bankers over at the Federal Reserve are dealing with a totally different reality. We're seeing a massive tension playing out right now. The Fed is holding their target interest rate steady at a 3.5 to 3.75% range, but U.S. inflation is actually accelerating, hitting 3.8%. Trading economics data shows wholesale inflation just surged at its fastest pace since 2022, and consumer prices posted their biggest jump since 2023. Because this inflation is proving so incredibly sticky, the markets have essentially completely rolled out a Fed rate cut this year. Actually, scratch that. It's not just ruling out cuts. Some traders are increasingly pricing in the possibility of a rate hike. And this sticky inflation data led to a really unusual situation, an 8-4 split vote among Fed officials. For anyone watching monetary policy, this is huge news. This marks the very first time 4 officials have dissented against a Federal Open Market Committee decision since October of 1992. It's basically a hung jury for monetary policy. You had Governor Miran actually voting to lower rates by a quarter point, while 3 other members actively objected to language even suggesting the central bank would eventually resume cutting rates. This 8-4 split perfectly captures the agonizing internal debate they're having over an economy that's growing fast but running way too hot. So the central bank is treading super carefully, noting they need to continuously assess incoming data and the balance of risks. But here's the key. They specifically noted that developments in the Middle East are contributing heavily to this highly uncertain economic outlook. They're standing ready to adjust policy if things go sideways, but that explicit mention of the Middle East is a massive clue. It points directly to those external supply shocks that are driving up prices and keeping inflation a real thorn in their side. Let's transition into Section 3, geopolitics and commodities, and look at these global ripples. Now, we all see the geopolitical headlines, but the actual impact on the mechanics of global trade and corporate strategy in 2026 is totally profound. FactSet data shows us that an incredible 211 companies cited the Middle East on their recent earnings calls. That is a staggering spike. It's the highest level we've seen in at least a decade. For context, the previous record was just 85 calls back in 2023. That means nearly half, 47%, of all S&P 500 companies felt they absolutely had to discuss how this specific geopolitical tension is impacting their revenues, their supply chains, or their overall macro outlook. And of course, these tensions are causing some wild ripples in commodities, creating a really fascinating divergence. Normally, gold is your ultimate safe haven during geopolitical stress, right? But not today. Gold actually slid down to $4,530 an ounce. Why? Well, it all goes back to that sticky U.S. inflation we just talked about. It's fueling fears of higher for longer Fed rates, which historically puts major pressure on gold. Meanwhile, oil and natural gas prices are staying extremely elevated because the near shutdown of the critical Strait of Hormuz is severely bottlenecking global energy shipments. It's a classic push and pull dynamic. Moving on to Section 4, Asian and emerging markets, which are currently on very divergent paths.
When we look outside the US, global asset allocation is telling two very distinct regional stories right now. Over in Asia, we're seeing some severe caution, with indices like South Korea's Kospi plunging over 6% and Japan's Nikkei feeling similar pressure. But flip the coin, and emerging markets more broadly are showing some serious structural strength. LCG data points out that output growth in a lot of these emerging economies is actually outpacing developed markets. Plus, with some analysts anticipating a weaker US dollar down the road and investors desperately looking to hedge against US tariff exposure, emerging markets are quickly becoming a critical diversification play and a massive investment theme for 2026.
Finally, we arrive at Section 5, the rise of CBDCs, or Central Bank Digital Currencies. This is truly the future of sovereign money. So, beyond the daily grind of stocks and commodities, governments are literally rethinking the fundamental nature of money itself. Now, to be clear, we are not talking about decentralized crypto like Bitcoin here. Central Bank Digital Currencies, or CBDCs, are fully state-backed, and their development is accelerating at breakneck speed across multiple major economies in 2026. Top news reports that governments are viewing these as a mandatory evolution. They want to massively improve transaction efficiency and cut down reliance on cash, all while keeping absolute regulatory oversight and monetary sovereignty strictly within the official banking system. They're not necessarily trying to kill cash tomorrow, but they are absolutely trying to overhaul the underlying plumbing of global payments. But as you can imagine, this is sparking a fierce international debate. The pros are definitely compelling, We're talking drastically lower transaction costs, a massive boost to financial inclusion for the underbanked, and a much sharper toolkit for central banks to implement monetary policy. But the cons, they are raising some major red flags. Giving a central bank direct, real-time visibility into every single transaction flow naturally brings up huge concerns around state surveillance and financial privacy. Add in the immense cybersecurity risks of a centralized digital ledger, and it's clear this is a highly controversial technological experiment that is rapidly becoming our reality. That wraps up today's explainer, but I want to leave you with a crucial question to chew on. Given all the incredibly complex crosscurrents we've just unpacked today, booming corporate earnings colliding headfirst with sticky inflation, high rates, and fracturing global supply chains, how are you planning to adopt your strategy? It is a true global balancing act out there in 2026. Thank you so much for joining me to explore these insights, and definitely keep this broader framework in mind as you navigate the markets ahead.